Good morning once again. Thanks for staying on. And we are about to start today's session. Today is day 3 of the Black Star Investor Webinar Series. Today it's for savings and loans, rural banks, and other financial institutions. And we have a wide array of speakers and also participants. We would have the governor of the central bank being represented by the director of research for BOG. We also have representation from the umbrella body for rural banks, that's Apex Bank. We would have somebody representing one rural bank giving us some insights, and we would also have a Q&A session. So what will happen is we will bring in our guest of honor for today, who is the governor's representative. Then thereafter, we would also bring in the moderators for the day, who will usher in the speakers with various presentations. Then we'll go into our interactive section. We also encourage everyone to type your questions if you have questions during the presentation, so that when we get to the Q&A session, we can have all that done. So without much ado, I'm going to introduce our guest of honor and our moderators for today. So the moderators for today will be Mr. Emmanuel Kujo, who is head of our securities trading at Black Star. And we also have Ms. Rita Yeboah, who is also vice president for our pensions scheme and our asset management business. The guest of honor today is Mr. Philip Abredu Otu. He's the head of research department at the Bank of Ghana. He's also a member of the Monetary Policy Committee. He's also on several major boards. He's on the Ghana Statistical Service. He's on the Ghana Export Promotion Authority board and many other boards. He's also worked with the IMF, and this short profile alone should tell you that we have a very high-profile person coming to be our guest speaker today. So, Mr. Philip Abredu Otu, if you can hear me, good morning and welcome to the Black Star Investor Webinar Series.
Thank you very much. Thank you very much for coming to the Bank of Ghana. And extending an invitation to the Bank of Ghana to participate. It's unfortunate the governor couldn't make it this morning because of the morning this morning. It's the middle of a board meeting right now. And Mr. Yasapong is also there. He's well versed in all these issues. And the governor has just asked me to just Ladies and gentlemen, a very good morning to you all. And let me first thank management of the Black Star Group for the invitation to participate in this year's investor webinar. The webinar is coming off on the heels of adverse global headwinds and domestic economic challenges that have heightened investor concerns. The chosen theme, effective recovery, resilience, and continuity amidst global market shocks, therefore fits the current environment as we seek to design policies to regain macroeconomic stability, a key requirement that is needed to attract investments everywhere in the world. In line with this, my remarks today will briefly touch on the current shocks facing the economy and the policies that are being put in place to regain macroeconomic stability to boost investor confidence. Let me begin with the current global economic shocks and policy responses. The global economy has been recently hit by two successive shocks. We've seen the COVID-19 pandemic and the Russia-Ukraine war. The pandemic generated intense supply shocks, which permeated every sector of every economy. The policy responses to dampen the economic and social consequences were swift and included accommodative monetary policies and fiscal stimulus packages. These notwithstanding, the pandemic led to a slump in growth. The global economy contracted by 3.1% in 2020, and Ghana recorded a paltry 0.5% GDP growth in 2020 compared to 6.5% the year earlier. In Ghana, fiscal policy responses principally took the form of increased spending, including transfers to households, granting of tax reliefs, and provision of utility subsidies to vulnerable groups, as well as financial support to small and medium-scale enterprises. These were also supported by monetary policy easing and regulatory relief measures to provide adequate liquidity to the financial markets to support growth and promote the use of digital forms of payment. Furthermore, an asset purchase program was triggered to help government close the budget financing gap. Now, let me move on to factors that aided the fiscal and monetary policy response. First, there was adequate policy space prior to the crisis. And what do we mean by this? The successful rollout of the aforementioned fiscal and monetary policy measures was hinged on some fiscal and monetary policy space prior to the crisis. Excuse me. Although monetary policy had enough space for accommodation due to muted inflation pressures and anchored inflation expectations before the pandemic. Thus, we see that it is important for developing countries to pursue prudent macroeconomic management policies so as to withstand adverse shocks when they occur. Then we also had the robust and resilient financial sector. The financial sector weathered the pandemic well, mainly due to widespread reforms to clean up and reposition the sector before the shock hit us. This included the upward adjustment in minimum capital requirement and regulatory reforms that saw the introduction of corporate governance and fit and proper person directives. Thus, when the pandemic struck, the banking sector was already robust and resilient, which afforded the central bank the unique opportunity to deploy regulatory reliefs. Then the other issue that arises is the post-pandemic economic recovery amid war and fragility of Ghana's economy. And I think this is where we are now. I think more than 2 years after the emergence of the COVID-19 pandemic in 2020, global economic recovery seems to hang in the balance as a result of the Russia invasion of Ukraine. Prior to the war, the global economy was on the path of recovery from the adverse effects of the pandemic. Global growth was estimated at 6.1% in 2021, following the 3.1% contraction that we saw in 2020. However, with the onset of a war in the first quarter of 2020, global uncertainties intensified, and then the growth outlook all of a sudden deteriorated. Global growth is projected to slow to 3.6% in 2022 on account of the lingering spillover effects of the war on global supply chains, commodity markets, and financing conditions, which have all tightened. In the face of rising food and energy prices, Global inflation rates have soared to historical levels, prompting central banks to switch from accommodative monetary policies that became useful in jumpstarting a global recovery from the pandemic to monetary policy tightening. This, coupled with rising uncertainty, higher energy prices, and worsening supply conditions, will slow growth further with association stagflation risks. The domestic economy has been hit by the spillover from the war. Just when the economy seemed to have rebounded from the COVID pandemic, recording a growth of 5.4% in 2021 from 0.5% in 2020, the war-induced shocks have slowed the recovery process. The economy grew by 3.3% in the first quarter of 2022 compared to 3.6% growth recorded in the same period of 2021. Current headline inflation is at a record high of 29.8% as at June 2020 from 27.6% that we saw in May 2020. And we have both food and non-food price pressures all contributing to this. Fiscal deficits and debt levels have deteriorated somewhat, while the Ghana cedi has depreciated by close to 20% against the US dollar in the year to 20th July due to increased demand amid declining reserve buffers and unfavorable financing conditions. Ghana's economy is vulnerable to external shocks due to its agrarian nature and the dependence on primary commodities, which exposes the country to adverse terms of trade. On top of this, the pandemic-related spending led to high fiscal deficits, which were financed largely from external sources, mainly Eurobond issuances. Thus, the recent downgrade of the economy by the rating agencies due to debt sustainability concerns virtually shut out the country from the international capital market. This created a dire situation of a widening financing gap, which was financed mainly from domestic sources alongside capital flow reversals, which exerted significant exchange rate pressures. Additionally, with pressures from adjustments in ex-pump domestic prices, increased transport costs, currency depreciation, and high food prices, headline inflation, as I indicated earlier, has jumped to 29.8%. I mean, contrast this to what it was a year ago when inflation was around 7.8% around April of 2020. This has prompted quick monetary policy responses with widening fiscal and current account deficits, rising inflation, a depreciating currency, and rising interest rates. The Ghanaian economy is currently exposed to very strong headwinds, which require prudent policy responses. Policy measures and the role of the central bank in promoting robust economic recovery and resilience is what I'll touch on next. Within such a difficult global environment, policymakers have explored several options to provide the right mix of policy response to the ongoing global shocks to support economic recovery. Although the global shocks are largely more supply-induced than demand-driven, the central bank's role in stimulating economic recovery, resilience, and continuity remains very critical, but heavily dependent on strong coordination with fiscal authorities. During the pandemic, both monetary and fiscal authorities in several countries across the world, including Ghana, turned to measures ranging from monetary policy easing to temporary relaxing regulatory requirements to fiscal packages, among others, to stabilize the economy. Now, to help re-anchor inflation and exchange rate policies, the Monetary Policy Committee of the Bank of Ghana has increased its policy rate by 100 basis points. It did increase the policy rate by 100 basis points in November of 2021. It further did a 250 basis points in January. And then it did another further 200 basis points and did another 100 basis. So in all, we've seen the central bank do about 550 basis points interest to try to stem the tide. In addition to the policy rate hike, the central bank has announced the reversal of COVID-related macroprudential measures and in the process increase the cash reserve ratio to 12%. It has reset the capital conservation buffer to the pre-pandemic levels of 3%. And it has also reset the provisioning rate for loans in the other loans exceptionally mentioned category. I think on the fiscal side, the execution of the budget has been challenging against the backdrop of macroeconomic developments. And for the first 5 months of the year, available data showed a higher deficit relative to what was programmed, driven by significant shortfalls in revenue relative to projections. And therefore, the revenue underperformance reflected delayed implementation of several new revenue measures, including the e-levy and arrangement of some 2 billion external financing announced in the budget. On the expenditure side, higher interest payments are also dominating and has led to some pressures despite restraint on primary expenditures, especially on capital expenditures, which has declined significantly. Financing of the budget has been met from domestic sources during the first half of the year, as planned borrowing from international sources did not materialize during the period. These fiscal challenges have impacted adversely on investor confidence. And therefore, on July 1st, 2021, the government announced its intention to seek support from the International Monetary Fund. Initial talks have begun, and it is envisaged that a fund-supported program. It is envisaged that a fund-supported program will help anchor expectations of fiscal restraint through implementation of reforms to restore Ghana's creditworthiness and eventually regain access to the international capital markets. Broadly, the engagement with the IMF is to provide balance of payment support as part of broader efforts to restore macroeconomic stability, safeguard debt sustainability, and boost investor confidence in the markets. I think that the markets have already started internalizing the positive effects of the engagement with the IMF. The outlook for the Ghanaian economy until the adoption of an IMF program is for continued tightened borrowing conditions, and this underscores the need to reprioritize our spending programs within the available financing envelope. So how do we make the Ghanaian economy resilient to withstand global market shock? The above monetary policy and fiscal policy measures, including the anticipated IMF bailout to stabilize the Ghanaian economy, are generally short-term in nature. For long-term macroeconomic stability, the following measures are imperative. A, I think we need to reset the fiscal framework to target debt stability and sustainability with emphasis on expenditure rationalization to attain positive primary surpluses. I think we also need to place emphasis on borrowing for investments rather than for consumption. And we also need to emphasize support to real sector development, value-added exports, light to heavy industrialization, and job creation. In addition, we also need to refocus monetary policy on its primary mandate of price stability. We also need to look at trade policy on the promotion of foreign direct investments and creation of comparative advantage to leverage on the African continental free trade area. We also need to pursue agricultural policies that are directed towards developing large-scale mechanized agriculture, industrial cash cropping, promoting value addition along agricultural value chains, and developing road and storage infrastructure to support distribution and marketing of farm produce, and so on and so forth. I think the future of Ghana starts today if we can commit to stabilize the economy in the short term, reposition the economy to withstand global market shocks, and implement long-term measures to reset the fiscal framework to regain as well as sustain investor confidence. When we are able to do that, we will then be able to set the economy on a path of sustainable growth where we can all conduct business in a sound atmosphere. On this note, ladies and gentlemen, let me once again thank the Black Star Group for organizing this webinar series. I have provided a picture of where we are coming from the past 2 years. I have painted a picture of the current situation in which we find ourselves, but I think it is not lost. We are girding our loins. We will continue with prudent macroeconomic management. And on this note, I wish you fruitful deliberations. And thank you very much for your kind attention. Thank you very much.
And I must say your address or your presentation is very timely, and it's resonates with the current situation. The globe finds.
I cannot hear anything. Is anybody hearing me?
Yeah, sorry, can you hear me?
Oh, I can hear you now.
Right, sorry, I think we had a bit of technical issue over here. So thank you very much for your time, and to be honest, your presentation is very timely and resonates with the current situation we have around the globe and in Ghana as well. And I must say, I was listening to your presentation, and some of the key things you touched on is what necessitated today's topic and today's audience and the participants for the call. I would ask that you stay on the call for a little bit. We have 1 or 2 questions that we want to throw to you. Moving on, I'll just read a bit of housekeeping rules for the call. If you join the call, we entreat you that you ensure your mic is put on mute and your video is off as well. Today's conversation, we have presentations from participants on our economy, especially from the financial sector, those who provide capital or provide source of funding to our SMEs who are needed for the recovery we want to achieve in the midst of this global issue. So we would have presentations from various speakers who are very astute and who are doing a lot in that space. Mr. Otu, I have a quick question here for you. And you know, the last MPC release, we realized that the policy rate was maintained. And I think one of the participants on the call really wants to know, is the BOG sensing that we are about to turn the corner when it comes to the trajectory of the inflation? Are we likely to see a reduction in the inflation rates in the near future?
So I think the simple answer to that question is that given the data that we have, we think that inflation could be peaking in about the next few months. So we seem to be turning around the corner. We need to observe the numbers a little bit more closely. And if you look at the monthly inflation numbers that have come in for the past 2 months, we are beginning to see some reduced tempo in the numbers, especially when you look at the month-on-month numbers, month-on-month increases in both the indices for the overall, for food and non-food. You'll begin to see that the rate of increase is slowing down. And our expectation is that that should crystallize into a decline in inflation in the not too future. That was a consideration. And I think the other consideration was that we had also on the real sector side, we are seeing a softening in the growth of the economy. That has been supported by our real sector leading indicators. And also, the committee also took that into consideration. The committee felt that we needed to give some support to the real sector. And I think the other consideration too is that if you look at what the Bank of Ghana has really done since November, when our forecasts were showing that inflation was going to rise, we started increasing the policy rate at the time. I think commentators thought that we had taken a premature step. Inflation was beginning to rise. I think we did 100. We did another 200. We did 250, and then we did 200. And in all, we've done 550 basis points increase in the policy rate. We needed to step back and then to watch this front loading of the interest rate hikes to work through the system and to see how that will impact on the aggregate demand component of inflation. There is an aggregate demand component of inflation, and that is what the central bank sought to address by increasing the policy rate. So yes, we are sitting back to observe what is happening to aggregate demand. We are also concerned a little bit about growth. And then on the brighter side, we see some reduced tempo in the increase of inflation. We think we need to pause a little bit and then look at all these things and then come back to the drawing table. So these factors have been the main overriding consideration in the decision that we took. Thank you.
Much, Mr. Otu. So I'll still plead that stay on the call for a little bit as you move on to our next speaker, who is Mr. Sapon, head Other Financial Institution Supervision Division at BOG, who would take the topic effective corporate governance and risk management principle in economic recovery. And today's conversation, as you can see, is going to be based a lot more on what the deposit-taking institutions are going to do to ensure that we head towards the recovery that we want. So without taking much time, Mr. Sapon, if you can hear me, you have the floor.
Okay, thank you very much, and thank you to the Black Star Group for this invitation to speak on this topic. Good morning to you all participants, and it is really an honor to join this webinar. The topic given to us to discuss this morning is effective corporate governance and risk management principles in economic recovery. Now, we have two big topics to cover in some few minutes. Corporate governance alone can take us days to cover, and same for risk management, but we will try and do justice to these important topics in some few minutes. I would like to start with a quotation from the governor of the Bank of Ghana. And this statement was made when, in 2018, we revoked the licenses of some financial institutions. Now, I won't bore you with reading the whole thing, but just to say that we at Bank of Ghana, we identify corporate governance and risk management to be at the core of board will not only have to work for the interest of internal stakeholders, in place, key management staff and employees, but the board will also have to look at external stakeholders and work in their interest as well. And in doing this, it is required that the board will be fair, will be transparent, will be honest, and work with integrity. So around the world, we have noted that we can say corporate governance codes can be described as either rule-based or principle-based. But here in Ghana, in the past, before the cleanup, we have what we call a mix of the two, but more of principle-based with minimum rules. So the past Banking Act and the Companies Act provided some minimum requirements on corporate governance, and our institutions were supposed to meet these minimum requirements and keep to international best practice. But things changed because, as I indicated earlier, the recent cleanup identified deep cracks and weaknesses in our corporate governance, in our regulated institution. We had big boards, insider dealing, lack of due processes, poorly diverse board. So Bank of Ghana turned its attention to deal with the situation. So we have moved more from the principle-based to the rule-based, and in recent times, where Bank of Ghana has come up with directives for our regulated institution. The Act 930 itself, that was enacted in 2016, has some enhanced provision of corporate governance. And the Act also empowered Bank of Ghana to come up with directives. So in 2018, we issued a directive that was applicable to banks, savings and loans, finance houses, and financial holding companies. And more recently, we have issued one for rural and community banks. In between 2018 and 2021, we all know that the Companies Act also was enacted, and it came with enhanced provisions on corporate governance. Now, the directive that we put in place is just to ensure that our regulated institution will adopt sound corporate governance principles and best practices so that they can undertake their licensed business in a sustainable manner. And another motivation was also to promote depositors and other stakeholders' interests. So it is not only about shareholders, but it's also about depositors who, in our situation, fund our regulated institutions, sometimes up to over 90%. So the directive, we believe, will promote and maintain public confidence and trust in our regulated institution. So the directives that we have provisions on who can be a shareholder, who can be on the board. We have elaborate provision on composition, diversity, where, for example, the directive for rural banks, for example, states that there must be at least one female director on our boards. So the directive also have provisions for chief executive officer, key management staff, internal auditing, external auditing, and there are other provisions on disclosure and transparency, and also ethics and professionalism. Now, moving on to risk management, we know that the banking business is risky. We license our institution to do financial intermediation, and financial intermediation involves risk. The taking of deposits, granting of credits, it's all risky business. And therefore, in 2021, again, Bank of Ghana came with some guidelines for our regulated institution We issued one for banks, savings and loans, finance houses and financial holding companies, and now we have one for rural and community banks. And these directives are to provide a framework within which our regulated institution will establish a culture of risk management. So the directive have some minimum standards that our institutions will have to comply. And the intention is that the right risk culture will be instilled in our institutions. So the directive provide guidance on how our institutions will identify, measure, evaluate, control, mitigate, and report risk. There are elaborate provisions which we can't cover in 15 minutes. So at the end of the presentation, we'll provide resources that we can refer to. So for risk management, everybody in the organization will have to play its role. I mean, operational staff have to play their role, key management staff, internal auditors, external auditors, chief risk officer, they have to play their role. But the responsibility is that of the board. So the board has the ultimate responsibility. They are the risk owners, and they have to develop the risk framework for their organization and provide effective oversight over senior management, as well as set and monitor risk appetite and instill the right culture in the organization. Now, the benefits we believe are enormous, and that if our institutions adopt good corporate governance and put in place effective risk management, there will be efficient and smooth operations. Our institutions will be able to mitigate risk and enhance their financial sustainability. Our institutions will have good corporate image and reputation, which can lead to improved access to capital and finance. We believe that adopting them will promote transparency, and lead to overall improvement in performance. So to conclude, we say that good corporate governance and effective risk management, they are critical success factors for our institutions to recover, and not only to recover, but to sustain high financial performance. So as I indicated, we have resources that will provide more information to our participants to be able to learn more about these topics. So on that note, I want to thank once again you all, Black Star Group and participants for your kind attention. Thank you very much.
Thank you very much, Mr. Sapon, for this brief but insightful presentation. And to our audience, we have a rep from your regulator over here, so I would encourage you to ask any questions, and let's open the forum for discussion around corporate governance and risk management, as he has mentioned. So to move on to the audience, I have Mr. Ganiru's hand up earlier on. Mr. Ganiru, if you can hear me, kindly unmute yourself and ask your question.
Hello.
Yeah, hello, we can hear you.
Hello.
We can hear you, please go on.
Can you hear me?
Yes, please go on.
Good morning.
Good morning.
Yes, my issue has to do with the fact that Bank of Ghana sometimes, I don't know, they keep saying they have to increase their policy rate because of the inflation and all those things. And I have a challenge with that, because if they say they are mopping up some excess liquidity in the system, when we know, in fact, average Ghanaian, even in fact, sometimes our purchasing power is dwindling. So I don't know, is the concept really practical as they are saying? Or sometimes I really have a challenge understanding that keep increasing this policy rate, which in effect is affecting the lending rate as well. I really have a challenge if they say there's excess liquidity in the system. In fact, some experts keep saying they should also look at the supply side instead of looking at the demand side. I'm not really sure whether people have so much in buying if you observe the system currently. So if they're saying they are increasing the distance to mop out the excess liquidity, in fact, many people really have that challenge. And I don't know whether probably they have better listen that some of us may not know that they want to also let us understand. Thank you.
So Mr. Otu would take this.
Yeah. Let me come in here a bit. Now, the issue about using the interest rate to try to control inflation, as the gentleman rightly put it, is a source of confusion in many minds. But let me break it down simply for him. Think about it this way. So the gentleman who spoke has some investments somewhere, and the gentleman who spoke is living in an economy where he has about 1,000 Ghana cedis somewhere. Now, for no reason of the gentleman, inflation has come into the economy and inflation is rising at 30%. What he should know is that 30% has eroded that 1,000 Ghana cedis that he has in his investment or with the bank. Naturally, because inflation is eating away his investment, he requires to be compensated somewhat. And therefore, that increase in the interest rate is not to make things worse, but one, to give him a little bit compensation for that investment that he has, let's say, in his treasury bill account. So it serves to try to make the rates a little bit more positive and to compensate him for that erosion in income and the erosion in investments. Let me put it this way, erosion in investments that he has in his, or else by the time he decides to go for this investment, all the monies would have been wiped out by inflation and it's no more worth it. So it tries, the increase in the interest rate tries to compensate. What the increase in the interest rate also does, I heard him talk about mopping excess liquidity. It's part of the framework the central bank uses. But this time, the increase in the interest rate is also supposed to try and put interest rates in a certain quadrant in the economy to also make domestic assets more attractive than external assets. To break it down, what the interest rate does is to make our domestic assets, in times of high inflation, if we don't make our domestic assets attractive, the economic agent like him will try to be looking for elsewhere to make more returns. He has the option to either push these resources into a domestic asset, or he can push it into a foreign asset. And the foreign asset we are talking about could be the exchange rate of a foreign currency. So he can decide to turn the 1,000 cedis that he has to look for dollars on the market. That action, if he decides to take that action, would put undue pressure on the exchange rate and then make inflation more worse in the economy. So that action to raise the policy rate a little bit is to make our domestic assets attractive, let people focus more on the domestic instruments than on the foreign instruments, which demand could bring about more inflation and lead to that virtuous cycle of inflation interest rate hikes. The other one is on the inflation side, and he talked about mopping up money, but we don't look at mopping up excess liquidity, but we look at trying to constrain aggregate demand, because if you break down inflation into its components, there's a component that is as a result of aggregate demand pressures that is coming from some liquidity in the economy that might be excessive, as he pointed out. There's a portion of that inflation that is due to crude oil prices and by extension, petroleum price increases in the economy. There's a portion which is due to transportation fares. There's a portion which is coming about as a result of supply chain issues. There's a portion which is coming also from taxes that have been imposed. And even there's a portion that is coming about as a result of foreign inflation, which is increasing because inflation in your partner countries where you trade with is increasing. Given the fact that the economy is import dependent, we will bring about all these high inflation from outside into our domestic economy. So if you decompose the inflation carefully and you look at the numbers carefully, you are left with that little option to focus on the portion which is aggregate demand driven and which is driven by liquidity concerns in the economy. Now, if the BOG were to be fully chasing the inflation rate, which is 30%, our rate should now be around 35%. But we recognize the fact that the inflation we are seeing is not purely a liquidity problem. It's not purely excess liquidity coming into the economy. And the factors, the breakdown tells you that that liquidity component, which is pushing aggregate demand, is not that excessive. And that is why, after all this increase in inflation that we've seen, what the central bank has done is only to increase its policy rate by 550 basis points, and that is targeted at something. I also heard him talk about the fact that we should be concentrating on supply side issue. And I think here I must confess that the central bank cannot do it all. The central bank cannot veer into supply side issues at this stage. That is reserved for other arms of the state to deal with issues like agricultural supply, food supply, and to make the system more efficient regarding services such that we don't see undue costs building up in those sectors. I must admit that is reserved for other sectors of the economy. Thank you very much.
Very much, Mr. Otu, for this insightful answer to what appears to be a confusion on what actually drives inflation and what the measures are, if the measures are working or not. I think I have another hand up from Dema Rural Bank. The rep from Dema, if you can hear me, kindly go ahead and ask your question.
Morning, sir.
Yeah, good morning. Kindly go ahead.
Good morning. Yeah, this mine has to do with corporate governance. It has to do with corporate governance. And then with the clearance, the BOG recently developed this TNF form or so, and that's the elected directors at the various AGM need to be cleared or approved by the BOG.
Okay, so I think we've lost the rep. We'll try to get him back to ask his question. Isaac, I see your hand up. If you can go on with your question.
Okay, thank you very much. My question goes to I think Mr. Sapon on the second presentation about the corporate governance and the risk framework. So I wanted to find out from his experience and the knowledge of its implementation, whether it comes with some extra costs to the institutions in implementing these corporate governance measures, as well as putting together these risk frameworks in the various institutions. The costs that it comes with, whether it's quite significant that it could deter some of the institutions from implementing them as effectively as it is required. So that is what I want to find out.
Okay, Mr. Sapon, if you can take this one.
Okay, thank you very much for the questions. And I think I got the input of the question from the participant from the MRO Rabat. And it's about the personality law forms that we ask prospective directors to fill. Now, as we all know, for regulated financial institutions, you can't just be elected at an AGM and just start to act as a director. You have to be taken through what we call the fit and proper test. And to help us do that is the form that we have designed that you have to fill and bring some additional documentation for us to assess whether you qualify and whether you are fit and proper to sit on the board of a regulated financial institution. So that form help us to determine the fitness and propriety of prospective directors. And the form was not only designed by Bank of Ghana, but also our security agencies that do the background checks for us. So that is on the first question. Now on the second question, yes, implementation of the Corporate Governance Directive and the risk management comes with some cost, but there are costs that our financial institutions should have been bearing anyway. So, for example, we require that every director will have to be certified once every 3 years. So that means that they have to go for a program that has to be paid for. And it is something that the banks or the financial institutions should have been doing anyway. We ask that the board, there has to be evaluation, for example, internal evaluation, external evaluation. So our banks or financial institutions have to pay for external evaluation of the board, for example. These expenditures, we believe, are critical to the survival of our institution. As I indicated in the presentation, corporate governance and risk management can bring institutions down, and indeed, it's led to the revocation of licenses of some financial institutions. And if those financial institutions had paid that extra cost, I believe they could have saved their institution from collapse. Thank you very much.
Thank you very much, Mr. Sapon. We have a few more questions, so because of time, we want to move on to the next presenter. But we entreat you, Mr. Sapon, to stay on the call. As after the presentation, we'll bring the questions back. The next topic we want to talk about borders around deposit protection, and as Mr. Sapon said at the ending part of his answer, about 400 financial institutions were taken down by BOG during the cleanup, and some amount of money was spent to protect deposits. So we have new institution that has been mandated to sort of provide insurance to these deposits as the financial institutions take them. So we would ask Mr. Emmanuel to do the next presentation, which goes around deposit protection. So, Mr. Emmanuel, if you can hear me, let me hear your sound if you can hear me.
Hello, can you hear me?
Yeah, I can hear you. Please, you have the floor.
Thank you very much. And let me say a big thank you to the Black Star Group for giving us as GDPC. So the topic here is protecting depositors' money through the Deposit Protection Corporation. But before we deal with that, I think it's just fair. It's in order that we give a little background of events leading to the establishment of the corporation, just to give context and perspective to the discussion. It's no gainsaying that our deposit-taking institutions play a very critical role in advancing the economic development of our country through their activities, including intermediation and maturity transformation, where they mobilize deposits, most time short-tenured, and transform them into loans, which are medium to long-term in nature. However, these activities inherently also have their own associated risks, be it liquidity, solvency, or corporate governance. And some of these risks sometimes crystallize and they result in institutions failing, and most often with depositors losing at least a part of their deposits. For this reason, most central banks across the world have set up what they call the financial safety net, which is just a set of mechanisms and institutions that are there to put in place measures to minimize solution architecture. Now, notwithstanding this, and this is a global phenomenon, no matter how strong your supervision is, your regulation is, banks still fail. And normally when they do, especially in a part of the world, the onus has been on the taxpayer to foot this bill. In response to that, especially after the last financial crisis, a lot of countries came up and established the deposit protection schemes, which was there to ensure that even if banks fail, the impact on depositors will be minimized. So the question then becomes, what is a deposit protection scheme? So this is basically a scheme that is set up to reimburse depositors on the occurrence of an event, which is a bank failure, which results in the central bank, in this case, Bank of Ghana, revoking their licenses. And this sort of scheme can be set up under 4 main mandates. It can be set up with the narrowest mandate, which is a pay box. So with a pay box, all you do is once there's an event that occurs and you are notified by the central bank, you reimburse depositors up to an approved coverage limit. You can also have a little broader mandate called the Pay Box Plus, where in addition to purely paying out and reimbursing depositors, you also have a little bit of resolution or receivership responsibilities. Then the next level is the loss minimizer, which generally speaking has, in addition to paying out, has absolute control over the resolution process. And the largest mandate for a protection scheme is what you call the risk minimizer, which in addition to the earlier ones, you also have the additional responsibility of supervising the banks. So these are the 4 main mandates. Why is it important? Is it important to set up such a system? At least we can talk about 3 main reasons. The first being to boost public trust and confidence in the financial system. So once you set up this explicit scheme, there's no certainty around which corporation is responsible for the payout in case an event happens. There's no uncertainty around the amount that each depositor is likely to get. And so these 2 things gives the public confidence that even if there's an event and the bank fails, 1, there's a corporation that will reimburse my deposits, and therefore it's likely to reduce a situation where there are runs on other banks. Another potential benefit of a scheme of this nature is to help ensure that our deposit institutions also play a role and contribute towards the cost of resolving failed institutions. And last but not the least, where there's confidence in the financial system, it's likely to encourage people to move their funds outside of the financial system into the formal system, and encourage financial inclusion as well. Now, coming back home to Ghana, the Ghana Deposit Protection Corporation became operational in 2019 September. But earlier, the first act that actually set up the corporation, the scheme, and the fund was passed by Act of Parliament, Act 931 in 2016. It was then in 2018 amended to incorporate a few changes, including covering foreign currency denominated deposits. The corporation has a 7-member board. Most of the members are picked from representatives from professional bodies within the country, including the Chartered Institute of Bankers, the Association of Ghana Industries, Ghana Bar Association, International Institute of Chartered Accountants, and the Ministry of Finance. So that's basically the composition of the board of GDPC. Now to the core issue that we need to address, which is how do we protect depositors' money? The scheme has designed a number of key features that enables it to do exactly that. And I'm going to go through a few in the interest of time. So they are the mandate, the membership, the coverage limit, how depositors are reimbursed, and basically the role of public awareness. So talking about the mandate, the law as it is now sets up GDPC as a pay box. In other words, once an institution fails and their license is revoked by Bank of Ghana, we are informed and then we reimburse depositors. One can say that the reason it was done is to ensure that as we just started, we were able to build the fund until such time that it is deemed necessary to expand the current mandate. So we are currently a pay box, and all we do is to pay off depositors when there's a failure and Bank of Ghana has revoked their license. In terms of membership, it is compulsory for all specialized deposit-taking institutions and banks to be members. And the reason it is important to ensure that every member is contributing towards the resolution, even if it fails by itself. This slide basically lists the member institutions. So we have finance houses, banks, savings and loans, microfinance companies, and rural banks. Now, when an event occurs, the question is how much is paid to each depositor. Based on the current law, for bank depositors, the maximum you get is up to 6,250, whilst that for the special deposit-taking institutions is 1,250. So this respective amounts are not automatic. So as long as your outstanding deposits fall below up to 125, you get everything. But if it's below 125, 1,250 for SDI, for example, you get exactly what your deposit outstanding is plus any accrued interest. In terms of how we compute this amount, what we do is that because the coverage is per depositor, we first aggregate all your deposits across the bank. And then once we get the total amount, we then subject it to the respective limits to determine how much each person actually gets. Now, in setting this limit, it is important that we understand a few things. So based on international recommendation, for a scheme of this nature to succeed, two things must happen. We should reduce moral hazard and also encourage market discipline. So moral hazard is basically a situation where an insured person or entity deliberately engages in risk, excessive risk, with the expectation that if the risk crystallizes, they'll get protection from the corporation. Whilst market discipline refers to, the lack of market discipline refers to a situation where people take exposures, like put their money in banks and refuse to monitor the risk of the banks. So it is important that when you are structuring your coverage, you take these two into consideration. Now, if you look at these numbers I've mentioned, that's the 6,250 for banks and 1,250 for specialized deposit institutions. Based on the numbers we received from our member institutions, we cover about 92% of all depositors. So the remaining 8 are mostly institutional depositors who have the capacity and the resources to monitor the exposure of and risk levels of banks that they are depositing their monies with. This slide basically lays out the scope of our coverage. So the box on the left basically lists the accounts that are covered. And I just want to add that mobile money accounts are also covered. So all these accounts are covered. And the slide on the right basically lists a few of the deposits that are not covered under the scheme. So for instance, the deposit that is frozen in compliance with an order of the court is not covered. The deposit of a key director, a director or key management personnel, a director or key management personnel who has worked with the bank, that's the bank that has failed, or specialized deposit-taking institutions for at least 3 years preceding the preparation of the returns. So these deposits are not covered. So it's a deposit that belongs to an accounting firm, account or auditing firm, a partner or a manager of that accounting or audit firm who is in charge of performing the external audit of the financial statement of the bank or SDI for at least 3 years preceding the preparation of the returns. So these are a few of the items that are excluded before we compute how much to reimburse each depositor. In terms of the payout, once an event occurs and the central bank notifies GDPC, we have a couple of days, up to 6 days, to come out with the modalities for payment. And once payment starts, our target is to make sure that we are paying and completing payment, or we pay a majority of our depositors within a 30-day period. If there's a depositor who doesn't make a claim after 30 days, they still have 5 years to make that claim. For depositors who are deceased, there's really no time limit for reimbursement, basically. This slide basically, is a pictorial reflection of what I just said in terms of the timeline for reimbursement. So Bank of Ghana revokes the license at day 5. The receiver submits the depositor data to GDPC, and then we announce the modalities for payment on day 6. And then by 30 days, we hope to have reimbursed the majority of depositor funds. Another key part of the feature of the scheme, which helps us to basically execute our mandate, is public awareness, just to build confidence in the financial system. In the past couple of years, we have been focusing on sensitizing our member institutions. We have really not come out publicly because we wanted to make sure that all the operational aspects of the corporation is ready to do a payout. But in going forward, in the next few months, you'll be hearing a lot from us in the public space in terms of educating the general public on the existence and features of Ghana's deposit scheme. Now, the Act also, to ensure that this scheme is successful, imposes some requirements on member institutions in terms of what their obligations are. And this includes the payment of premiums and submitting accurate monthly returns to GDPC. The reason that submission of data is critical to GDPC is that without data, obviously, we'll not be able to compute who the eligible depositors are. And lack of that data will obviously impede the speed and promptness of any reimbursement that we would have to make upon the failure of an institution. As part of our process as well, we really engage with other key stakeholders. We are a member of the Financial Stability Council, which includes the Ministry of Finance, the Pensions Authority, National Insurance Commission, and the Security and Exchange Commission. Thank you very much.
Thank you very much, Mr. Asare. So we have a couple of questions here, and I think the first question, it will go to Mr. Sapo if he's still on the call. So I don't know if I should say it's a question or a concern, but the participant over here is asking whether the BOG considered the cost implication of the new directive to a sort of reappoint directors that they ask them to leave them and reappoint them for a 4-year term. The participants want to know if the cost implication was considered by BOG. So, Mr. Sapon, if you can hear me.
Hello, good morning. Please, I'll answer the question on behalf of Mr. Sapon. So please, if you can go over the question again for me, please.
Sure. So the participant over here wants to know if BOG considered the cost implication of directing them to terminate the appointment of the CEO on regular employment and reappoint them on a 4-year term. I want to believe they see a lot of cost burden on this directive, and he wants to know if the cost implication was considered.
Okay, thank you very much. I am not too sure the actual cost he's referring to, but if you are reappointing the same person, it presupposes that you are just renewing the person's contract. But unless there are other cost implications that he may bring to our attention, then maybe we can specifically respond to that. But I'm not aware that if you are re-engaging the same person, renewing the person's contract for another term, if that has any significant cost, there might be some other processes you may go through. But maybe unless we know specifically which costs are involved, then maybe we can discuss that. Thank you very much.
Goes to the presentation from GDPC. So the participant wants to know, in every insurance, again, depending on the policy, they are usually cash payback in the event that so he wants to know if they in cases where the event does not happen, do they get cash payback from the GDPC?
Thank you very much for the question. If the questioner is a depositor by the depositors, the premiums are being paid by the banks. But like I said earlier, bank failures happen. Strong supervision, strict regulations don't prevent bank failures. So it is very unlikely that in the medium to long term, there will be no bank failures, or not just bank, but SDI failures will not be there in Ghana. Now, in case the event doesn't happen in a long period of time, the Act actually provides for a lot of things that can be done, including maybe a suspension of a premium payment by the banks. So there are other options that, however, to be realistic, bank failures, not just bank failures, but failure of our deposit institutions, as we've seen over the past couple of years, happens almost all the time. Thank you.
Response. I think the follow-up question, which for me, when I read the definition as stated in your Act, I see this 2 letters, 2 words, I should say, over here: protect small depositors. So my question is, what is the definition of a small depositor?
Well, for us, our focus is to protect vulnerable depositors who don't have the capacity to and the influence to monitor the places where they put their money. That's really the focus. And so before the limits are determined, we look at the distribution of the deposits across both banks and SDIs. And we make sure that the limit is consistent with global best practice, where they say the coverage should be at least protect 90% of depositors. And as we speak currently across our member institutions, the numbers that we have shows that we are covering 92% of depositors. Thank you.
Thank you very much. So we have two hands. If you can hear me, kindly unmute and ask your question. We would also encourage that you put your questions in the chat box.
Thank you very much. Please, my name is James Okra, calling from Best Point Savings
We
and
would
Loans.
also encourage that you put your question. Please go on.
Yeah. You know, I want to know the basis of the payout to a bank customer of a maximum of 6,250 and then that of a savings and loans of 1,250. Are we paying different premiums, or we pay the same premium per every deposit that you have? Because I can't see why a bank depositor, in the case of a bank collapse, will receive 6,250 and that of a savings and loan will receive a maximum of 1,250. Are the banks paying different premiums from the savings and loans, or is the same percentage that we all pay? Thank you.
Thank you. So thank you for the question. Before the premium levels were determined, like I said, we look at the profile, the deposit profile of both banks and SDIs, of which savings and loans are a part. And the profile are very different. The average size of a deposit in the bank is larger than the average size of a deposit in the SDI. If you apply the same rate, like I said, it runs counter to the principle of minimizing moral hazard and ensuring market discipline. That is why, based on the data structure of each of the segments, it was deemed necessary to make sure that we are not only asking for a separation, but your coverage levels is lower. In terms of premiums, yes, whilst you may be paying the same rate, which is 0.3%, the quantum of premium obviously is larger for banks versus SDI by nature of the difference in the average size of deposits. Thank you.
Wow. Okay, because I have no right to ask a question, so it's okay. But it's unfair, because if we are paying the same premium, then in case of any collapse, we should be reimbursed the same thing. Anyway.
Thank you very much. So because of time, we'll ask those with their hands up to keep them up. And we have a couple of questions here that we are going to hold on to. We'll move on to the next presenter, then we'll get back to the questions in a bit.
Sure. Thank you very much. Very insightful conversations we are having here. We've looked at the global market shocks that have happened and the effect on our local markets. We've looked at the effective corporate governance and risk management in economic recovery, and we've looked at protecting depositors' money through the PC. Our next speaker will be talking about strengthening the capacity of the NDFIs through prudent investment strategies. His name is Dr. Joseph Osei Asante, Head of Risk and Credit Management at ARB Apex Bank. Dr. Asante holds an MSc in Economics and EMBA in Banking and Finance, Economic Policy Analyst USA, a certified operational risk manager, a fellow of the Global Academy of Finance and Management USA, a fellow of the Association of Certified Chartered Economists, USA Global, and a Chartered Global Management Accountant. Mr. Asante, if you can hear me, you have the floor. Mr. Asante. Hey, sorry, Dr. Asante. Apologies for that. Dr. Asante, if you can hear me, you have the floor.
Okay, so thank you very much. Thank you very much, and a good morning to everyone over here. I'm excited to be here once more, and I will take the next few minutes basically to share some insights can you hear me? Can you hear me, please?
Please, we can, loud and clear.
Okay. So I'll take the next few minutes to share some insights on the topic that we have been given to discuss on. I am here representing the Managing Director, Mr. Alex Kwesiewua. Mr. Alex Kwesiewua is attending to very critical meetings currently in another location. And as such, he's asked me to step in and do the presentation on his behalf. I will be talking about building strong NBFIs through prudent investment and liability management. And to do that, I would first share the outlines. Can you see the slides, please? I want to find out whether we
can.
Okay.
Yes, we can.
Okay, so thank you very much.
Slide.
So, the outline for today's discussion under prudent management of investment and liabilities. I'll start by talking about investment policy. I'll start by talking about what do you mean by prudent investment. Then I'll move on to investment policy. Thereafter, I'll share some insights on risk management systems. Then on investment framework. Thereafter, move on to investment and liability policy. Talk about operational procedures. Talk about responsibility of board of directors. Talk about responsibility of senior management. And then land on risk management, internal controls, and reporting. First of all, let me just give a basic idea about what this particular presentation seeks to do. That in the midst of the post-pandemic, in the midst of the post-COVID, definitely financial institutions and non-banking financial institutions are now putting themselves together and seeking to do business once more and making sure that they are resilient should there be any such event coming up again. Today, we are talking about the probability of such unplanned events like this, which we have seen, the pandemic, such unplanned events coming about. In fact, today they are talking about bio-threat risks. They're talking about bio-threat risks that have come on board. That how are banks positioning themselves to deal with bio-threat risks? And we'll talk about that later on. But now, let me first go on to my first slide, talking about prudent investment. Today, Bank of Ghana has put in place measures that seek to make sure that non-bank financial institutions are safe, they are sound, they are secure. And by that doing, quite a number of pruning steps were taken, and we have a reduced number of non-bank financial institutions today. It is all about making sure that the existing ones, the existing non-bank financial institutions have the capabilities, they have the risk systems, they understand the business in which they are, and to ensure that depositors' funds are safe and secure and do not fall into wrong hands. And so to start with, prudent investment and liability management decisions rely on three key things. That if you are a non-bank financial institution, these three key things should guide you. That you want to ask yourself, what is the level of tolerance that your institution seeks to undertake? What is your risk appetite? And what is the kind of risk culture that you have within your institution? How do you take liabilities? What assets do you place these liabilities in? What kind of risk incidents are you monitoring within your space? So these three things are very important. That prudent investment and liability management depends on these three key things: your tolerance level, your appetite, as well as your culture. And to understand this, there are critical requirements that need to be met if we intend to manage our investments properly. What are these critical requirements? I'll start first of all by talking about the mixture and diversification by type. MBFIs take deposits. They take all sorts of deposits or whatever. Into what do they put these investments? The mixture and type of the diversification that you would do would go a very long way in determining how you will survive. How will you be able to meet demand deposits? How will you be able to meet the demands that your depositors make? Second one, next critical element is about the restrictions and the limits that you place on the financial instruments. that definitely there's some restrictions. The quantum instrument, the ceiling, you should set some restrictions and ceilings for yourself as to what kind of maximum ceiling you place some of these liabilities. And again, the next one is about matching your assets and liabilities. Matching your assets and liabilities. We have seen instances where short-term instruments are put into long-term instruments. These are things that are not new to us, but the risk that is involved, we take savings and then we use that. We have seen MBFIs that have collapsed today, largely because they were taking deposits and they were putting them into mortgages, they were putting them into properties, putting them into estate financing, etc. These are critical risks that non-bank financial institutions should be very careful about. And then the fourth one is about the level of liquidity. These critical requirements are important for us to note when it comes to prudent investment. And so the next thing is that for an MBFI to be sustainable, an MBFI to be sustainable and exist and be able to meet its deposit as and when it becomes due, the next issue that we are more concerned about is about policy guidelines. Policy guidelines seek to make sure that MBFIs comply with their own internal policies, put in place a policy, an investment policy. And what should this investment policy cover on which areas? The first one is your risk profile. Determine your risk profile, that which areas, which kind of assets will be interested in putting into? What kind of liabilities you are interested in taking on? Are there liabilities that are significantly huge, that when such liabilities become due, it becomes difficult for you to quickly pay? No, you want to look at the next one, the asset allocation. Which types of long-term assets would you want to place your liabilities into? The limits on the allocation of assets, the holding restrictions of some asset types, that you should put in place restrictions on some asset types, that it is not every asset that you want to place some of your liabilities into. And the kind of conditions that you create for the kind of assets, the conditions on the creation of assets, your policies will cover this area. Your policies will also cover the accountability and responsibility of your asset transactions, all the various loans and advances that you intend to embark on with the liabilities and the deposits that you embark on. Who takes care of, who is responsible for that? How do you account for that? How do you ensure that these assets are recoverable such that when the liabilities are due, you can quickly attend to them? The next point, the next item, again, for a sustainable and a strong MBFI, is about putting in place an enterprise risk management framework. An enterprise risk management framework. We are not going to go into looking at enterprise risk management framework. There are 8 components within an enterprise risk management framework. Later on, we can talk about that. But what this enterprise risk management framework seeks to do are these. 1, the enterprise risk management framework should seek to monitor all the assets that get created, put in place a strong internal control system that will be checking the kind of assets that you create, that will be checking the documentations, etc. That will be checking that the due process has been followed in the creation of the assets. Put in place a management oversight, a board and management oversight. That is the governance structures, the committees, etc. that take decisions. We have seen MBFIs that are one-man owned, that decisions are taken by the main person, the CEO. He decides on where to put the money. He decides on the quantum, that etc. that should be placed. These are risky moments that we have gone through. Put in place a timely identification in terms of audit procedures, a timely identification of weaknesses that exist in the risk management framework and the risk management and the enterprise risk management. Put in place timely identification of control weaknesses. For instance, we're talking more about how do you identify that at any point in time, the deposits that were received from one end were placed in a certain investment firm or placed in an institution where maybe a director has an interest in that particular institution. These are control weaknesses that audits should be able to identify. Put in place internal procedures that monitor the asset liability positions. That is to say, how many MBFIs even have ALCOs? How many MBS have asset and liability committees that on a daily basis monitor the asset and liability positions at any point in time? For a strong NBFI, we are talking about putting in place an asset liability management committee that on a daily basis, put in place systems that you are able to get reports on a daily basis on your AL positions at any point in time. Again, stress test your portfolio at any point in time. There are various stress tests that you can talk about. You can stress test on your interest rates. You can stress test on inflation. You can stress test on your liquidity coverage ratio. These are important things that you should do as an MBFI to ensure that the investments that you are holding are safe, they're sound, and at any point in time, you are positioned to be able to provide to your clients as and when they need them. The next one is about putting in place an investment framework. That is a documentary thing. But the key things within the investment framework are these. One, put in place a documentary guidance that talks about your code of ethics and your professional conduct. Put in place a policy that tells us that there are specific ethics that you follow when you obtain deposits and when these deposits are due to be paid. Put in place a risk management activity. For instance, we're talking about put in place your KPIs, your KRIs, your key risk indicators. Put in place your risk register. Put in place your risk dashboard. Put in place all the risk management tools that on a daily basis monitor these investments and tell you, for instance, weaknesses that are inherent in your institution and how what steps you need to put in place to ensure that you mitigate such risks. And again, put in place reporting procedures to the appropriate level. Your investment framework should have critical guidance on reports, where the reports should be sent to, what types of reports, qualitative reports, quantitative reports, reports that have the various ratios that tell you the performance matrices of the investments that you hold. Again, the next one is to look at the investment and liability policy. Put in place, for you to build a strong NBFI, put in place the investment and liability policy. What do we mean by that? The investment and liability policy. The investment and liability policy, we are talking about, one, establish your overall risk philosophy. Establish your overall risk philosophy. You cannot do investments and not appreciate, you cannot manage investments and not appreciate risk. It's a critical component. Put in place or establish your overall risk philosophy, that you are here with a specific vision. You are here with a specific mission, that you seek to protect the depositors' money. You seek to ensure that the value of your depositors are maintained and ensure that the value of your deposits are always commensurate with market trends. The philosophy should be always maintained. And again, within your policy, what needs to be highlighted? The composition of your portfolio. Establish the kind of composition. Are you going to do short-term investments, long-term investments, medium-term investments? Read the markets at any point in time and determine at what point in time you will need to either disinvest your investments either from long-term into short-term. For instance, the kind of volatilities that we are seeing today, market rates are rising. If you have investments that are largely in long-term, what kind of decisions should you take? Would you want the kind of volatilities that we are seeing with the CD dollar appreciation? If you have investments in long-term, what kind of decisions that you are supposed to take? That your composition should be responsive to market trends. That is what your policy should take to do. Again, the third one, that you should put in place statutory limits and, more importantly, concentration limits, as well as diversification. And I want to talk more about concentrations. That prudent investment management, prudent investment and liability management seeks to look at how you can avoid concentrations. and diversify your portfolio in such a way that at any point in time, should there be a risk event, you will not be found wanting as to the loss of potential deposits at any point in time. Put in place, again, authorization procedures, decision-making. At what level are decisions taken? Who takes the decision at any point in time? Who takes the decision at any point in time? You want to ensure that authorization of placements, authorization of investments, follow through a certain hierarchy of decision-making. You want to ensure, again, lastly, that you put in place the appropriate legal documentations. What we have seen, and I believe we have seen that during the clampdown of non-bank financial institutions, where some of them licenses had to be withdrawn. I am sure they came out, or they found out instances. They found out instances where even documentations covering some investments that depositors had made could not even be found. I'm sure some of the investigators will tell you that put in place legal documentations covering the kind of deposits as well as the kind of investments that you do, both on the client level as well as on the corporate level. The next one is about the operational procedures. What operational procedures should MBFIs be concerned about? What operational procedures? The first one under operational procedures is that address exposures that are inherent within your balance sheet and your off-balance sheet. There are exposures. If you are an MBFI, that you have off-balance sheet items, you have letters of credit, etc. I don't know whether you are even allowed to do that. You have letters of credit, you have off-balance sheet, and all types of contingencies that you can talk about. Put in place a tracking mechanism that tracks the potential of such off-balance sheet exposures crystallizing. And as such, you want to make sure that when you do such thing, you are covered. You have the appropriate collaterals to cover them. Again, put in place the issues, guidance on conflicts of interest. Conflict of interest. We have seen instances, which I just mentioned. We have seen instances whereby an MBFI, for instance, a director on an MBFI, for instance, because of where he finds himself, decides to take decisions that MBFI places investments that this MBFI has collected in a company that the director has interest in. Conflicts of interest. Avoid conflicts of interest. Again, under operational procedures, ensure that you put in place measurement and assessment of the performance of your investment. Track on a daily basis if there is a need to secure an application, a software application that tracks the performance of the various investments on a line, on item and line by basis. The various investments, 30-day investments, 91-day investments, the returns on the interest on a daily basis that you are making. Put in place a daily performance assessment of your investments so that you can identify weaknesses at any point in time. Next one, under operational procedures, put in place a tracking mechanism about your exposure to fluctuations in interest rates. Put in place a process that deals with fluctuations in interest rates as we see today, fluctuations in exchange rates as we see today, as well as fluctuations in market volatilities. Let information on the market guide you in determining your decisions, in determining where you do your placements. These are critical. We are in critical moments as we are recovering. And as we are recovering, we are going through moments that are volatile. We are recovering under a volatile market system. And a volatile market system, and as such, decisions should be on a daily basis as well as on a timely basis. Still on operational procedures. Put in place procedures for tracking impaired investments. Impaired investments. There are investments that can be impaired due to one or two instances. There can be impaired investments. That is to say, if you have placed your investments in an institution, that institution is either getting insolvent, or basically winding up, it becomes impaired. How do you recover them? Put in place the next one, procedures for selection and approval of new counterparties. That is to say, which institutions do you intend to put your investments in? You take the deposits, of course, to put them into certain instruments. These instruments, if they are not GOG and they are private led, then you want to undertake an approval process of counterparties. Do due diligences on counterparties. Subject your counterparties to due diligences before you embark on them. Again, next one, establish internal regulatory limits and procedures, internal procedures for decision making, and ensure that anytime violations are made, non-compliances are made, you hold people accountable. You hold people accountable. And then, still on operational procedures, establish the type and frequency of reports, the types of reports. There are various reports that if you have a very good application, that is an investment, a largely tailor-made investment application, it can give you various types of reports. And the frequency to me should be such that it is daily. It is daily. Good. The next thing, for a resilient NBFI, the next thing is about the responsibility of the board of directors. The board of directors are crucial in this space, in taking decisions, in providing guidance for an NBFI. What are some of the responsibilities the board of directors should embark on? First of all, is an approval process. The responsibility of investment and liability policies lies on the board of directors. Board of directors of NBFIs should review the policies. They shouldn't just be brought to them for them to just stamp and okay it. No, they should review the policies, and as such, they should be knowledgeable in that area, in that space. They'll be very knowledgeable. Again, the board of directors should annually review and approve investment policies of this NBFI. They should also conduct a day-to-day. They should delegate the responsibility of the day-to-day monitoring of these investments and liabilities mobilizations. The day-to-day, they delegate the responsibility to management. We are in a delicate area when it comes to NBFI. We have seen instances of malfeasance, and as such, for a strong NBFI in these current times, you need to have a day-to-day monitoring. Again, it's the responsibility of board of directors to subject long-term investments to actuarial valuations. We're talking about putting in place models that value. We talk about the value added, the value at risk models, the capital asset pricing models, the net present value models. These are models that give you a fair idea about the strength, about the strength of your investment, about the adequacy and the strength of your investments at any point in time. It gives you a better idea about the risks that are associated with the investments that you have put in place, and the probability that losses can take place at any point in time, and decisions on what actions you need to take. These are models that you as NBFIs, we as NBFIs, we should put in place. This particular area is very important, as putting in place valuations on your investments. There are models today on the market that can be secured and used at any point in time to value the kind of investments that we do. The board of directors should seek to ensure that senior management are up to the task. We are talking about competent, qualified investors, people who have been examined and have passed appropriate examinations and have experience in investments. They have experience in liability management. These are the people that we're talking about. In such instances, recruit people who are up to the task and understand their responsibilities. The responsibility of senior management in ensuring that we have a resilient NBFI. What are the first ones? Senior management at any point in time can't take decisions on their own. They should seek approval on investment decisions that they want to take. They should seek approval. And again, appropriate levels of knowledge and experience should be embedded in such senior management. If you are not qualified, you shouldn't be placed in taking decisions. And when you take a look at some of these international banks, go to the International Bank, go to Standard Chartered Bank, go to Barclays Bank. People who sit in such roles are qualified people. People who sit in such roles have been examined. They have the experience. They take decisions based on data, based on knowledge, based on experience. Put in place such things because they are managing monies of clients. And as such, we don't want to see experiences of anomalies and all those other ones that have occurred in the past years. And again, put in place remuneration policies that are structured, that can motivate and attract seasoned people and prevent unauthorized risk taking at any point in time. And then still the responsibility of risk management, senior management, in ensuring that we have a resilient NBFI is to ensure that we respond to environmental and market conditions. In these current times, where we have volatile situations, investments are critical. Decisions on investments are critical. That you don't make mistakes at any point in time. Make sure that if you are not sure, you don't do anything at all. Finally, risk management and internal controls. What are some of the things that should be put in place for a strong and resilient NBFI? What are some of the things? Under risk management, the first thing is to monitor the compliance of policies, review the risk mitigation activities, make sure that we are using the appropriate risk management tools, the KRIs, put in place the KRIs, put in place the risk register, put in place a risk dashboard that monitors all risk events, put in place an incident loss event register that seeks to track potential, and in fact, put in place early warning signals about investments that are getting bad. Again, under risk management, review the asset liability and liquidity positions on a daily basis, put in place contingency plans to ensure that deteriorating conditions are stamped quickly. Internal controls, their responsibility will be to check on documentations and ensure that documentations cover all types of investments that are being made. They will need to also report on weaknesses and investment control, weaknesses in investment controls. And finally, also control dependencies on vulnerability to key personal systems. We're talking about staff that would always want to stay on their job. They don't go on leave. These are vulnerable situations. People have to go on leave whenever they are due. Dependency on staff is a key risk that needs to be tackled by internal control. And then internal controls will also need to check on whether transactions have been carried out in conformity with the prevailing market terms. Check on that and report on that. Internal control will need to check independently on interest rates and market rates and ensure that rates that are being given to clients, rates that are being given to, that are being arranged and agreed with other institutions conform with policy guidance. Finally, reporting should be regular and timely. Reports should indicate clearly understandable terms. That is to say, reports should have qualitative and quantitative trends. There should be some advisory trend as well to key senior management as well as board. And again, senior management should be compensated. More frequent reporting should be ensured in this environment. These key things are critical things when it comes to ensuring that we build strong NBFIs through prudent investment and liability management. Thank you very much. And I would want to end over here.
Thank you very much, Dr. Asante, for that passionate presentation. We have some hands up from our audience, so we'll just take them. Mr. Alex Asma, if you can hear me, you can go ahead and ask your question. Mr. Alex Asma.
Hi, good afternoon.
Good afternoon.
I was following up on the question to Mr. Sapon, which was answered by one of his colleagues in relation to the cost that the Bank of Ghana expected from the corporate governance directive they issued to the banks. He mentioned evaluation of external evaluation of directors and the annual certification of directors. So the question was about the cost implications to the banks when the directive asks that the banks terminate the appointment of their CEOs who prior to the promulgation of this directive were on regular employment. They were never on fixed-term contract. They were on regular employment. But the Corporate Governance Directive took a retrospective effect and asking all their contract appointment to be terminated and be given a new appointment on a 4-year fixed contract. And what that means is that for CEOs that have served 8 years and above, they have only 4 years to leave the scene. Were they not expecting that the bank will have to pay compensations and other severance pays to these CEOs when the appointment is to be terminated on the basis of the Corporate Governance Directive? That's the kind of, I think the response was not based on this background. So I wanted to throw a bit more light on that.
Mr. Yasapon, if you are on, can you please take that question for us? Or if he's not on, if there's a representative for him, if he can take the question for us. Mr. Yasapon?
Thank you so much. Yeah.
Okay, it looks like Mr. Yasapon is not on at the moment, so we'll try and get the response and then share it with Dr. Alex Asma. The next person on the line to ask a question is Nana Yaolabi. Sorry, Nana Kefulabi. Nana Kefulabi, if you can hear me, you can ask a question now. It looks like Nana Kefulabi is not ready. So in the interest of time, we'll move on to our next speaker. Our next speaker will be speaking on the topic Building Strong Rural Banks Through Prudent Investment and Liability Management, the Amenfiman Story. The presentation will be given by Dr. Alex Asma, CEO of Amenfi Rural Bank. Dr. Asma, please, you have the floor.
All right, thank you very much. I am sharing my screen.
Yes, please.
Just a moment. Okay, thank you very much for having me, and it's a great privilege to participate in this webinar. Okay, good. Thank you for that. I'm speaking on building strong rural banks through prudent investment and liability management. So my outline will be looking at what is a strong bank, liquidity requirements, making prudent investment decisions, and then I will share a bit of the Amenfiman experience. So in terms of a strong bank, I want to take this from what's in the view of the regulator, the Bank of Ghana. A financial institution is assessed, and from that assessment, then they will come out to describe you as strong or distressed or satisfactory or whatever level you are. So they are looking at 5 things. Solvency, which is looking at how a bank will be able to meet its long-term liabilities or obligations. They're also looking at liquidity, how quickly a bank can convert its assets into cash or into liquidity to meet its immediate obligations. They are looking at earnings, the capacity of the bank to be able to generate the revenues to match the expenditures and return on amount invested. They also look at management systems, and they look at systems and control. In my own words, I regroup this as first liquidity, solvency, profitability, progressive growth, as in strong balance sheet backed by high quality asset, and a strong brand presence. So when I put liquidity first, the reason is this. As financial institutions, cash is like your blood. When you lose it, you are going off. And it's like you catch COVID, there's no much time for you to do much about it. You have to respond or you die. If you catch HIV, you are likely to be around and manage yourself for some time. So liquidity is like something that can take you off within a moment. And so to me, liquidity really is top most thing to look at. To be able to meet your immediate term obligations is critical. Customers draw check on your counter and it's payable on demand. You don't have to negotiate. You don't have to ask them to go and come back tomorrow. You don't have to do anything than to pay. And that comes with liquidity. Solvency is important. You must survive. You must have the capital base to be able to mitigate your risk. You must be able to have enough reserves to be able to take care of your long-term obligations and to be able to cover substantial risks that you take to run the business. And earnings in line with profitability, you should be able to make adequate profit to be able to return dividends to your investors and grow your reserves to back the organization. And in addition, you should be able to grow progressively, not really growing abnormally, but then progressively, you should be building a strong balance sheet backed by high asset quality. And then your customer confidence should give you a strong brand presence so that customers are confident when they leave money with you, they will always come back. And whenever they ask their money, they will get it. And really, really, that puts you there as a very strong bank. Now I'm looking at when customers give their money to us, what do we do with it? First of all, there is an LI 1825, which is the ARB Apex Bank regulation, actually requires all rural banks to deposit 5% of their deposits with ARB Apex Bank. It's a placement you don't negotiate. At any moment in time, 5% of your deposit is with the ARB Apex Bank. 8% is supposed to be kept as primary reserve in line with Act 930, and then 30% is supposed to be kept in secondary reserve in line with Act 930. And now, as we saw Ms. Asari explain, the Deposit Protection Act also places a requirement on us to pay some 0.3% to protect depositors' money in case of bank failures. So all of these amounts are not available directly to the bank to use because some are based on regulation and you have to comply at any point in time. So if you calculate this, roughly you have about 57% of the deposit that is available for lending. And so as a bank or a rural bank, you have to play with these numbers and see which amounts are available for investment and then which of investment options and vehicles are available for you to be able to remain strong and healthy. So obviously, once you have money, you have a lot of things you can do with it. So one thing is that you can lend the money to people who need money to do business or to for finance their consumption or anything. And so you're going to get return as an interest rate and other management fees when you lend to customers. You can also place on the money market and make money. You can place on the capital market to make additional return on that. And you can do many things with it. But the question is, what objectives are guiding you in taking that investment decision? So the first thing is most important that your investment objective should be guided by the ability to generate liquidity from that investment. So this is the reason why many of the institutions that went down really went down. They were not all of them were really that bad, but because they have placed money in certain areas, that is difficult to convert them into cash or into liquidity when they needed it. So in that case, you have money, you can't have access to it, and therefore you don't have money. So when customers come to you and they say they need their money, you don't have the money. And so one person goes to town and tell the other person and tell the other person, and by the next 2 hours, the whole community has run to your bank. And if you could pay 1 or 2 people, could you pay 50, 100, 200 people when they come to you? And that really, you are off the same day. By the next moment, it's on radio that you are being closed down because you don't have money. And where people's treasures are, that is where their hearts are. So once they see you don't have money, everybody then comes to take their money and they kill you instantly. So liquidity in taking investment decision is the most critical thing to consider. Once you consider your liquidity, then you want to look at the safety of the capital. So many have taken investment decisions, go for higher returns, and they never considered the safety of the capital, and they ended up losing the capital. So the capital never returned, and there are many institutions as of today that have money locked up in defunct institutions that were closed down by either SEC or the BOG that have their money still locked. Most of the institutions under BOG have been paid though, but the institutions under SEC have not been paid. And so capital is actually locked up. So the safety of capital is critical. Then on the third thing, I will look at the return I'm getting on that investment. What is the rate that I'm getting and what is the tenure of that investment? So this is important because you need to always be matching your assets to your liability. So if customers give you money that they are going to take within a maximum of 1 year period, as in fixed deposit, and or everyday withdrawal, as in SUSU savings or current account or savings account, then you can't take a longer tenure asset position. You really have to match that. So your tenure should be looked at when you are considering your return, and as well as the rate. So then you look at what vehicles are available. I mean, investment vehicles are available to place. So I am limiting the conversation. Now we are not doing credit, we are not doing lending. We are just focusing on, after you have put some aspect of your money into lending, the rest, the 30% that is a required holdings as secondary reserve, is supposed to be placed on securities that are safe, that you can easily convert. If you do not give all your 57% left into loans, then you have some surplus money that you still have to invest. So where do you put all those monies? So the available vehicles that I can talk about is first, government treasury securities. And I'm talking about treasury bills and bonds. Treasury bills and bonds. And then we talk about time deposits, that is depositing these monies with other financial institutions or other banks, commercial banks, or any licensed institution to be able to make an income on that. Or you consider a corporate bond. This is not too developed for the kind of business we do, and also a bit of risky area. So I will also limit further the conversation on government bonds and treasury securities. So when you are taking that decision, you need to focus and analyze your risk. As much as possible, you want to put the risk to the lowest level possible. But as you all know, the higher the risk, the higher the return. So there are chances that you also want to maximize your return. So you need to balance your return and your risk so that you don't go for high return and risk the capital and even that return, or you don't stay too low that you also don't get enough return on that. Be a balance. So I want you to apply your mind to these risks when you are considering government securities, especially if you want to trade in the secondary market. So first of all, there's an interest rate risk you have to consider. You know, when you buy a bond, there's a fixed interest rate that you have agreed, and for the tenure of the bond. At any point in time, if you want to convert that bond into cash, you will be looking at, the market will be looking at what interest is prevailing now, vis-a-vis what interest is already committed on that bond. So if the interest rate in the market is rising, then the value of your bond will be going down because your bond will be sold at a discount. As we have the situation now, if you took a bond sometime back last year, you may have taken it between 15 to 18%. And now interest rate is far above that. So it means that your bond could be converted into cash or liquidity at a loss because you're going to lose value. And this interest rate risk, you must always have it. The reverse is also true because there's always an inverse relationship. If the market is giving a lower interest rate and you already have a higher yielding bond, then you could be getting a premium also on your bond if you want to liquidate it. So this also will help you to choose when to liquidate and when not to liquidate. Then you also have a reinvestment risk. When you get your coupons on your investment, your idea is that if you don't have pressures on cash or liquidity, you'll be reinvesting the coupons. And so you calculate your yield in line with how much more you can generate on the coupons as you reinvest them during the bond tenure. Now, what happens is that these market conditions can really affect the rate you will get when you are reinvesting. The market as it looks now, the rates are going up. So reinvesting the coupons is a good idea because then you get more or higher return. But when the market is heading downwards in interest rates, then you get less when you are reinvesting the coupons. And so these are also important to look at. Then obviously inflation risks. I mean, we have Ms. Otu from Bank of Ghana explaining this very clearly to us, the relationship. And so when inflation is going up as in 30% thereabouts, and you have taken bonds that were 15% last year, then what it means is that you're already losing value because you're expecting to be paid 15% return when inflation is already 30%. So your return is already eroded. And so in terms of real return, you're actually getting a reduced value. And so this kind of risk must also be looked at. Then your investment considerations. Mr. Santi took time to talk to us about investment policy. I'm not going deep into investment policy, but I'm only saying that your investment policy must give you a direction on what the objective of your investment is. Is it to generate an income? Is it looking at fixed term income? Are you to protect capital? So this objective will help you to choose the vehicle that is appropriate to meet your company policy. In addition, it will also define your risk appetite. And your risk appetite will also help you to know what type of venture, what type of risks you would take looking at your investment decisions. Then you have to look at the liquidation options. I've spoken so much about the importance of converting your investment into cash. So liquidation is critical, and you must look at it in terms of whether if you liquidate, you are going to incur some losses, or if you liquidate, you are going to make some gains, and what time is appropriate to liquidate in line with your cash planning or your liquidity planning, so that you don't have to rush to the market to convert your investment into cash when it is bad to do so. If you have your plan all planned out well, you only go to the market when it is appropriate. And then you also have to look at the returns on your investment and the investment tenure and the capital adequacy. I think I've spoken about those two before. So, so I'm going to just move on straight to capital adequacy. The idea is that every investment that you place, you really have impact on the calculation of your capital adequacy. So some of your investments will give you a zero risk in terms of your calculation. Others are risk rated higher. So the different instruments or securities have different assumed risks. So for the regulator, all government securities are zero risk rated. That means if you have bonds or you have treasury instruments, once is a demand on the government, the impact, the risk impact on your capital adequacy ratio is zero. So in that means the whole amount will be factored into your capital adequacy calculation. But if you have invested in other instruments and other securities that are not government securities, then you have between 20 to 50% assumed risk in your capital adequacy calculation. So then that impacts very strongly on the capital adequacy of your institution. So you may have the money in somewhere, though, but because of where it is, the risk factor really reduces how that money impacts on your capital adequacy calculation. So I think that is also something that you need to know. So having spoken about that, let me just took a bit of time, a few minutes to explain or to share that my experience. So where have we come from? We have all come from the appetite for higher return, where we are all jumping into the market and buying fixed income instruments that gives you higher return and all that, all of that. We used to have a policy that says that 70% of your investment should be on government instruments and 30% can be on other instruments. So we took advantage with that 30% playing around until 2018 or 2018, when the banking reforms, or what they call banking crisis, actually came up. And then it brought everything to test. So if you were lucky and at that time, most of your amounts were with Bank of Ghana regulated institutions, like the commercial banks that were revoked, then praise God. It means that you got your money. Even though it took you a bit of time, you actually got your money. And that was our situation. So we were able to make a lot of the recoveries because most of those funds were with Bank of Ghana regulated institutions. But yes, still, we had some of the monies that were with SEC-regulated organizations. And those with SEC-regulated organizations, you and I can agree that it's still something that we're fighting. In some of the cases are even in court, that we don't know when government is taking decisions on them. So that really brings you to a test of time. So if you do not have enough investment on government securities that you can easily convert, then the customers would test you. And that was our case. I mean, we were there one day and we had information that in some community, people were putting themselves in buses because they've heard that the bank was collapsing. So they want to come and collect their money. So it's just a matter of responding immediately and paying everybody. Somebody was to the bank and he said, I have 700,000, I'm taking cash. I'm not doing transfer, I'm not taking any financial instrument, I'm taking cash. And he's there demanding cash. And if you don't have 700,000 to pay over the counter, even though operationally you're not supposed to pay that kind of amount over the counter, but this is a test. And so we go to the vault and we put 700,000 and pay this person. He look at our face and say, oh, so your bank is not collapsing. Okay, then put it back in my account for me. I mean, this is the test. If you feel this, you are off. And so having a spread of our investment across various vehicles really help us to contain the pressures and be able to overcome the crisis. Then came COVID and all the issues. If you didn't have money coming from the banking crisis and COVID came, then your problem is even much more complicated. But because of all of these things, we're able to maintain the resilience through these difficult times. It's been like 4 years of toughness in the market in that space, because if you play in if you work with the informal sector, mostly in rural communities, information runs like everything they hear is true, absolutely true. And so they will definitely act on that. And so it was so important that we have a lot of available cash from many sources, especially our investment in government bills, to be able to respond and do that. Now we have to try and stay purely in control. So our decision and our policy has been revised to say that all investments must be 100% on government securities, period. So we want fixed income, but we want it on government bonds or treasury instruments that are tradable. So anytime you want the money, you can easily convert that into money. And that is where we did our search in the market some 4 years ago, and then we found Blackstar Brokerage. And I must say that they've been an outstanding partner, managing us in the secondary market making sure that we are trading when it is appropriate, making sure we are liquidating when it's appropriate, making sure we are buying when it is appropriate, advising us on daily basis. You get the emails every morning advising you on what is happening in the market, what's the exchange rate, what is the interest rate, how the bonds are doing, and then giving you a direction. You really give you a sense of confidence and comfort, and you always know that whenever you need money, you have it. They help you to plan your liquidity in such a way that you don't rush to take decisions in the market. You only do when it is appropriate to do. So I think that this has been an awesome journey, helping us to navigate the difficulties and stay much in control. And so I want to use the opportunity to appreciate you, Black Star Brokerage, for that services you are offering to us. And I hope that many institutions who avail themselves will equally receive that kind of service. And then you help all of us to stay in control. On that note, I want to thank you very much for your attention. Thank you.
Thank you very much, Dr. Asma. Thank you for everything that you shared. Thank you for recognizing our efforts and appreciating us. Just to add to what he has said, the asset liability management service is something that we render to all the banks here. So just as Dr. Asma has shared, all the banks here, if it's something that you'd like to explore to us, do not hesitate to reach out to us. We can take a look at your holdings and advise accordingly. One key point I want to share from Dr. Asma's presentation, he said strong NBFIs are backed by high quality assets, compliance with liquidity requirements, solvency, and profitability. Blackstar would like to partner with you as you embark on this journey. We'll take questions from our audience at this point in time if there are any.
Sure, and as we wait for questions from our audience, I want to ask Mr. Asma, and to in an extension to our previous speaker, Mr. Dr. Osei, right? So I think when I looked at the data and speaking about Government of Ghana securities, and at this point from the presentation, it's very clear that the quality of the assets that you put the deposit or allocate the deposit to is very important. So when you look at the data for savings and loans and rural banks, you will see from 2017, they had a lot of allocations to treasury bills, which means, the very short end of the yield curve. Then along the line, I think up to date, that distribution has reduced a little bit. However, they still have a lot of money at the front end, which is treasury bill, 91-day, 182-day, and 364-day. Now, my question is it the case that maybe a lot of rural banks do not know the existence of the bond market where they can buy a bit longer securities and get a bit higher return on those investments? Or is the case of rural banks and savings and loans restricting themselves to making sure they have good assets and liquidity management, liquidity matching in terms of the duration?
All right, thank you very much for the question. I think that you almost answered it. And how they stand to benefit. So a bit of information will be helpful. I also think that generally, when you talk about government securities, the first thing that comes to everybody's mind is government treasury bills. The idea that you can be trading on the secondary market is also not so much something that we know. And so I think this is where your team comes in, and then you also try to do a bit more of education among the sector players so that you open up some of these opportunities to us, all of us.
Thank you very much. And as Mr. Asma said, at Blackstar, we aim to give you the needed information for you to be able to play on the Government of Ghana secondary bond market. So I guess after this call, would make sure we stay in touch with the rural banks and the savings and loan companies on this call. Give you all the emails and the contact people you can speak to in case you want information about the bond markets. Yeah, we just allow about 3 minutes because we've had enough time on the call today. Interesting conversations from various speakers. So we'll allow about 3 minutes. Anyone on the audience list would want to ask a question, or if you want to raise your hand and put in a question verbally. Right, and let me also acknowledge that I've seen the conversations on the chat box. I think a lot of the conversations has been between the GDPC and our audience. You know, a lot of them seeking clarity and expressing their concerns on what they think. You know, in a very loose way, says some of them considering it as unfair when it comes to the payment to that. I'm happy this dialogue has happened on the chat box. Since we don't have a lot of questions from the audience so far, I want to believe they all understood what has been shared and have taken them in good faith. Once they don't have questions, it means there isn't you know, ambiguity in the presentations, or everyone really appreciate the presentation. So we would, yeah, in case you want more information on how to play on the secondary market, after this call, our business development team would reach out to you, send you various emails with contact people for you to speak to if you want a lot more clarity on the secondary market and how to buy bonds. And as Mr. Asma said, we've partnered them since for about 4 years, and we've showed great quality when it comes to our service delivery to them, and we are happy, you know, we are part of the story as he shared. So to end the conversation today, I'll hand over to the host, who is Nana J. Ajiman, who's our CEO, the CEO of Blackstar Brokerage and a director of Blackstar Group, to give us a closing remark.
Thank you, Emmanuel, and thank you everyone for being on till now. Today has been a very interesting day, and we've even gone 30 minutes beyond the indicated time. Once again, thank you for staying on. But before we all leave the platform, business development team has dropped a link in the chat box with a poll. We need to get this better and better. So we encourage each and everyone to participate in this short poll before you leave the meeting, or before you click your leave button. But today has been a very insightful one. We are meeting you tomorrow, and tomorrow will also be another interesting one. If you have plans of not showing up tomorrow, I bet you tomorrow is the day that you have to be on. And tomorrow, our topic or our focus is just on building global giants from Ghana, and I think that's something that should be of interest to everybody. And we'll be hosting the CEO of GIPC, the CEO of Ghana Export Promotion Authority, and we would be hosting another entrepreneur who's also been raising the flag of Ghana high. I don't need to give you a lot of the details. All I say is join us tomorrow for tomorrow's session, which will be a very good one. On this note, we would like to extend our maximum appreciation to the governor's rep, Mr. Philip Abredu Otu, and we also like to thank our resource persons who came on today, starting from Mr. Sapon from the Office of BOG. The acronym for his department is Office, Other Financial Institutions. And we also like to express our gratitude to Dr. Ose Asante, who also represented the MD of Apex Bank. We also want to express our gratitude to Mr. Emmanuel Asari, who represented the GDPC CEO. And finally, to Dr. Asma for also partaking in this session. We We are much aware that he's out of the jurisdiction, but he took time off his busy schedules outside the country to also make a presentation. And more importantly, and particularly to the hundreds of participants on this platform, we are very much grateful for your time, and we look forward to seeing you tomorrow. So once again, kindly spend a minute or less to take part in this short pool that's showing up on the platform, and we look forward to seeing you tomorrow. Bye, but for now, thank you.